$35 billion. That's what Google's advertising empire is worth. And in January 2026, a federal judge will decide whether to tear it apart. Judge Leni Brinkema already ruled Google guilty of monopolization. The DOJ wants forced divestiture within 12 months. But here's what nobody on Wall Street is calculating. The last time a tech monopoly was broken up, shareholders didn't lose money. They made 600% returns. And I have the court documents that prove history is about to repeat itself. Every time you see an ad online, an auction happens. In milliseconds, advertisers bid to show you their message, publishers sell the space, and someone in the middle takes a cut from both sides. That someone is Google. They own the tool. They own the tool advertisers use to buy ads. They own the tool publishers use to sell ad space. And they own the exchange where those transactions happen. It's like owning the New York Stock Exchange, the biggest buyer and the biggest seller. Simultaneously, Google didn't build this empire from scratch. They bought it. In 2008, they acquired DoubleClick for $3.1 billion. The Federal Trade Commission approved it. In 2010, Invite Media for $81 million. In 2011, AdMeld for $400 million. Each acquisition added another layer to what insiders call the AdTech stack. By 2015, Google controlled the buy side, the sell side, and the marketplace. And the Department of Justice says every single acquisition was designed to eliminate competition. This is the official DOJ press release from April 2025. Quote, "The Department of Justice prevails in landmark antitrust case against Google. Judge Brinkema found Google guilty on 3 of 4 counts. Monopolization of publisher ad servers, monopolization of ad exchanges, and illegal tying of their products together. Google controls 90% of the publisher ad server market. 90%. The only question now is the remedy. And the DOJ wants blood. But here's where it gets interesting for your portfolio. Because the DOJ isn't just asking for fines, they're asking for structural separation, forced divestiture, the complete dismantling of Google's advertising infrastructure. And if you think that sounds like it would destroy shareholder value, you haven't studied the AT&T breakup. If this kind of financial investigation is new to you, you're in the right place. We decode billion-dollar tech wars and what they mean for investors. Every single week. The trial lasted 15 days in September 2024. Google's defense was simple. We compete fairly, consumers benefit, and breaking us up would harm the internet. The DOJ's argument was devastating. They showed internal emails where Google executives wrote, quote, "Our goal should be all or nothing. Use AdX as your SSP or don't get access to our demand. Stop. Before I show you what the DOJ actually wants, you need to understand what Google built. Picture a stock exchange. On one side, you have buyers. On the other side, you have sellers. In the middle, the exchange matches them and takes a fee. Now imagine one company owns the exchange, the biggest brokerage for buyers and the biggest brokerage for sellers. They can see every bid. They can see every bid before it happens. They can manipulate the auction. They can charge fees on both sides. That's not a free market. That's a rigged casino. And Google built exactly that system. The DOJ calls it the stadium. Owning the stadium, the teams, and the referee. Google Ads is how advertisers buy. Google Ad Manager is how publishers sell. Google AdX is the exchange in the middle. And here's the personal connection if you've ever wondered why ads feel. If you've ever wondered why ads feel like they're stalking you across the internet, this is why. Google sees everything. Every bid, every impression, every click. They know more about online advertising than anyone else because they built the infrastructure. Quick question, do you own Google stock? Type yes or no in the comments. Follow the money. An advertiser pays $1 to reach you. Google's buy-side tool takes a cut. The ad exchange takes another cut. The sell-side tool takes a third cut. By the time that dollar reaches the publisher, who actually created the content you're reading, they might get 50 cents, sometimes less. Google published a study claiming they only take 30%. Independent researchers found the real number is closer to 50%. Half of every advertising dollar, vanishing into Google's stack. Send this to anyone who thinks Google is just a search engine. But taking fees isn't illegal. What's illegal is how Google maintained this system. The DOJ proved Google used tactics called first look and last look. First look meant Google's exchange saw bids before competitors. Last look meant Google could adjust their bids. Imagine playing poker where one player sees everyone's cards. That's not competition. That's what Judge Brinkema called willful, anti-competitive conduct. Google also destroyed evidence. The court found that Google employees routinely set chat history to off by default. Internal communications that should have been preserved for litigation were deleted. Judge Brinkema explicitly criticized this in her ruling. Wait, I know what you're thinking. Google is too big to break up. It would never work. Let me show you why that's exactly what they want you to believe. Because we've done this before, and the results will shock you. This is the DOJ's actual remedy proposal. They want Google to divest AdX completely. Full sale within 12 months under a court-appointed trustee. They want Google's publisher ad server, DFP, evaluated for contingent divestiture after 4 years. They want the auction algorithms made open source and relocated to a neutral third party. They want a data firewall preventing Google from leveraging search and YouTube data. And they want 50% of AdTech revenues escrowed starting immediately. This is why I investigate these systems. Subscribe if you want to see. Subscribe if you want to see what Wall Street won't show you. But we're not done. Because behind every antitrust case is a financial outcome. And the outcome everyone expects, that breakups destroy shareholder value, is historically wrong. January 1st, 1984. The United States government broke up AT&T, the largest company in American history. They called it Ma Belle. Analysts predicted disaster. Shareholders panicked. What actually happened? The greatest wealth creation event in telecommunications history. AT&T controlled everything. Long distance, local calls, the phones themselves. They were a regulated monopoly for decades. When the breakup happened, AT&T's assets dropped from 150 billion to 34 billion overnight. A massive drop. A 77% reduction in book value. Employees were terrified. Investors sold. The media declared it a catastrophe. But the government wasn't destroying value. They were unlocking it. Because monopolies don't maximize shareholder returns. They maximize control. For every 10 shares of old AT&T, shareholders receive 10 shares of the new AT&T plus 1 share in each of 7 Baby Bells. Regional phone companies, suddenly free to compete, free to innovate, free to grow. But the spreadsheets from 1984 don't show what happened next. Within 12 years, buy and hold investors saw 600% returns, with dividend reinvestment, compound annual returns of 18.5%, outperforming the S&P 500 every year, ranking in the top 10% of professional money managers. They don't teach this in business school. Now you know what institutional investors have known for decades. Have you ever sold a stock before a major ruling? Share your experience below. And here's the part about you, because I saved the most important evidence for last. Google's AdTech business generates $31 billion annually. That's roughly 9% of Alphabet's total revenue. But controlling the infrastructure of digital advertising gives Google power far beyond that revenue number. If forced to divest, analysts estimate the separated companies could be worth $30 to $35 billion. Possibly more, much more. Because competition creates value. The monopoly suppresses. AT&T headquarters, 1984. Google headquarters, 2025. Same room, different furniture. The government said AT&T was too powerful. AT&T said breaking them up would harm consumers. The government broke them. The government broke them up anyway. Consumers got better service, lower prices, and more innovation. Shareholders got rich. The Baby Bells eventually recombined. SBC acquired the original AT&T in 2005 and took its name. The cycle completed. But the wealth had been created. Check your portfolio. If you own Google or Goog, the same pattern is unfolding right now. Send this to someone who needs to see it before January 2026. This is Alphabet's SEC filing. The network segment, which includes AdTech, generated $31 billion in 2024. Now look at the reference I showed you earlier. The DOJ press release confirms Google holds 90% of publisher ad servers and 50% of exchanges. When you control that much of a $31 billion market, divestiture doesn't destroy value. It reveals the value that was hidden by monopoly pricing. You will live through this ruling. The question is whether you see it. The question is whether you see the pattern before it happens. Subscribe to understand tech economics before the next phase begins. Here's my controversial take. This breakup isn't punishment. It's value creation disguised as regulation. The DOJ doesn't care about shareholder returns. But history shows that breaking monopolies often benefits everyone, including the shareholders who thought they'd lose. The AT&T patent suggests Google could outperform the market over the next decade, specifically because of forced competition. Not despite it. Tell me I'm wrong in the comments. You can't unknow this now. Every headline about Google antitrust, you'll recognize the pattern. The only question is what you do now. What do you do with this information before January 2026? What tech company should I investigate next? Most interesting suggestion gets the next deep dive. But Google isn't the only big tech company facing an antitrust reckoning. OpenAI just lost a $3 billion acquisition because Microsoft's contract blocked them, and Google swooped in with a structure designed to avoid FTC review entirely. It's called the reverse acqui-hire, and it's the new playbook. It's the new playbook for big tech M&A. If these investigations matter to you, subscribe and hit the bell. I expose what mainstream financial media won't touch every week. Click here for the windsurf investigation, or click this one if you missed the Amazon expose. See you there for the next breakdown of how the world's biggest companies really work. We are tracking every move the DOJ makes until the 2026 ruling. Is there any specific part of the 2026 ruling you want me to break down further in the next script, or should we move on to the OpenAI investigation?